And welcome. Good evening, one and all. It is Tuesday, the third Tuesday of the month, September the 19th, for our monthly financial literacy seminar series. As we continue again today, I will be your host today, Benyamin Levy, with HTK 1847 Financial. So happy for you to join us today. We're going to be started in just 1 minute. As at 6 o'clock hour, just allow a few more to join us, as this seminar is going to be recorded today. It's a good one. It's called the Cash Flow Statement. And we're going to explore what that means and how it applies and how you can use it and benefit from it. So again, I know time is of the essence, and I do appreciate those that do come on time, which is so very important. And so we want to allow for those that do come in to hear the whole presentation. But again, this is going to be recorded. So if you do miss anything, I will be posting it out later for full playback. So again, welcome one and all to the third Tuesday of the month, the Money Matters series. Today we're going to be talking about the cash flow statement. Again, I am Benyamin Levy. I'm a financial advisor at 1847 Financial and HTK under the umbrella of Penn Mutual. And this firm provides a wide range of services with the primary commitment to helping our clients pursue their unique financial objectives. We want to help you develop an overall strategy tailored to your goals, time horizons, and risk tolerance. Just a little bit about me. As you know, I have over 30 years of financial service experience, and I'm happy to say I have now joined with an excellent firm. Again, HTK Financial 1847 is ranked one of the top broker-dealers in the country, in the industry, and then under the umbrella of Penn Mutual, which has over 175 years of experience. So this firm is dedicated to helping individuals evaluate their financial situation. We want to provide people with tools that can help them make informed decisions. We are offering informational materials on a wide range of topics because we understand that individuals have diverse financial needs. If you have any questions or concerns during the course of this presentation, we invite you to take advantage of our complimentary consultation. During the consultation, we will discuss and answer the questions, begin with the process of helping you develop a financial approach that will address your individual needs. Now, keep in mind that the information in today's material is not intended as tax or legal advice. It may not be used for the purpose of avoiding any federal tax penalties. Please consult a professional for specific information regarding your individual situation. So let's jump right in. Again, family, because we have a lot to cover here, and I want to make room for questions and answers. Again, as we go through, do take notes, if you will, and you can actually place in the chat, and I will be asking you from time to be interactive in responding in the chat as we go through this. But any questions you may have, so I'll make sure to not forget them as we go through. So let's begin. Money matters. Cash flow statement. What do we start with? Money. That green money, paper that's in your pocket. Look at it. It's a simple linen cotton paper. It doesn't weigh much. It doesn't take up much space, but printed money is a major part of our lives. In 2022, the Bureau of Engraving and Printing is expected to print, listen to this, up to 9.6 billion pieces of paper currency with a face value of 365 billion. How much of that money is going into your savings and investments? Money is one of the things that we think about every day. even many times a day. But while we think about it and talk about it and worry about it, we sometimes fail to take the time to manage our cash effectively. Every successful investor knows that management of cash assets is the key to a sound strategy. To begin with, you want to understand how time may influence your ability to reach your goals. Next, you also want to take a look at your financial profile and examine your credit standing and your cash holdings and whether it is time to rebalance your cash portfolio. So if you would, if you begin for me, type in the chat, if you will, manage our cash effectively. Type that in the chat. All right. Let's go through this. Credit score. Credit score advantage. What is that? Once you understand that the role time plays in the long-term investment outlook, you can better be prepared to make wise decisions when it comes to cash management. Having a good handle on how your credit score can affect your purchasing power, if you could type in the chat, purchasing power can also help. There can be a correlation between your credit score and the rates you may be charged for any type of installment debt. And the higher credit score, the potential to add up to real savings over time. So let's look at an example here. Let's assume and consider you have $400,000 loan and a 30-year fixed rate mortgage. An individual with a credit score of 620 will qualify for a mortgage interest rate of about 6.89%. At that rate, the mortgage will carry a monthly payment of about $2,632. Now let's look at what happens when the person's score is above 760. With that credit score, the individual will qualify for a 30-year fixed mortgage with an interest rate of about 5.49%. The monthly payment would be $2,269. The difference is nearly $363 per month, or $4,450 per year. So over the lifetime of that mortgage, 30 years, the difference can add up to over $130,000, almost 1/3 of the cost of the home, just because of your credit score. Again, type in the chat. Give me a 1 if you think that's significant. Who believes the significant difference by having a good credit score and how much that makes of a difference? Give me a 1 if you think that makes a difference. Your formula, okay? One of the goals to a sound financial strategy is finding the appropriate mix of investments. At the bottom of this illustration that you see here is cash alternatives, which have low risk, but also offer low potential returns. As you move higher up the illustration, each section represents an opportunity for higher potential returns, but carries a higher risk. So if you could, again, put in the chat for me. Low risk, and low potential returns. That's cash. The reason why cash alternatives are the foundation of a well-balanced portfolio is that cash alternatives allow you to meet short-term and unpredictable expenses. If you will, type in the chat, short-term, and unpredictable expenses. Having cash and cash alternatives may also allow you to manage other investments rather than selling at what could be an inopportune time. That's cash. Keep in mind that allocating your assets among different investments is an approach to help manage investment risk. It does not eliminate risk of loss if security prices do decline. Now, speaking about cash, the FDIC, the Federal Deposit Insurance Company, insures your bank accounts up to $250,000, $250,000 per depositor, per institution in principal and in interest. However, other cash alternatives, such as a money market fund, if you type in the chat for me, money market funds, not insured or guaranteed by the FDIC. So there is a big difference there. And any other government agency. Money market funds seek to preserve the value of your investment at a $1 per share. However, it's possible to lose money in investing in a money market fund or other cash alternatives. Okay, so make a note of that. Mutual funds are sold only by prospectus. Please consider the charges, the risks, expenses, investment objectives carefully before investing. A prospectus contains this and other information about the investment company can be obtained from your financial professional. Read it carefully before you invest your money. Let's look at some trends. Trends in debt and household savings. One effect of the financial crisis of 2008 and 2009 was that America broke the long-term trend of low personal savings, as the chart shows you here, and increased the amount of money they save. As this chart illustrates, the total household debt, which is that gray line, rose continuously from 2006 until it hit the high in 2008. That's the debt level. Following that time, the financial turmoil, the personal savings rate as measured by the Federal Reserve continued to climb steadily until 2012, when the personal savings reached over 11% of disposable household income. Later, as the economy recovery gained more momentum, personal savings once again slowed, and while household debt climbed to new levels. Okay, so once the COVID pandemic hit, personal savings skyrocketed to a peak of 33.8%. That's 2020. Look how that spiked up there. And in April of 2020, before leveling back out to around 5% in 2022. Meanwhile, the non-household debt balance grew steadily to 1.6 trillion in 2002 to almost 4.5 trillion in 2022. So over a 20-year period, as you can see, it went, the debt went from 1 trillion to 4 trillion. Wow. Again, put in the chat if that sounds significant to you. Trillions, not billions, but trillions of dollars difference over a 20-year period. Put a 1 if you think that's significant. And as you take a closer look, the personal savings rate spiked higher, during the pandemic. As Americans' personal savings rates climbed higher during the pandemic, the rate of savings growth in the U.S. has slowed as economic environment has improved. Meanwhile, debt has steadily risen. So you see that the debt is continuously going up but the savings is going in the other direction. This pattern of spending during good times and saving during bad times is understandable. But another approach to consider is a steady, consistent program for savings. So where to put my money, you ask the question, right? For this portion of a portfolio, you must liquid. For this portion of the portfolio that must be liquid, most investors consider one or more of 4 places. Each have drawbacks and advantages. As you see on your slide here, you have savings, certificate of deposit, money market, and treasury bills. So let's look at the first one, savings, a traditional bank savings account or checking. The advantages, they both are guaranteed up to a certain limit by the FDIC. However, traditional bank accounts returns are modest at best. So if you would, type in the chat for me, FDIC. When you think of your bank accounts and checking accounts, they're insured up to $250,000. So FDIC bank accounts, very safe. But again, the returns are very modest. Certificates of deposit, CDs as they're called, are time deposits. They're offered by your bank or thrift institution or credit unions. They may offer a slightly higher return than your savings account, but they also may require a higher amount of deposit. If you sell before the CD matures, you may be subject to penalties. So if you would, type in the chat for me, penalties when we're talking about CDs. So banking, savings accounts, CDs, both of them are FDIC insured up to $250,000 per depositor and per institution, and generally provide a fixed return. Whereas your value of your money market, which is the next one we're talking about, these funds can fluctuate. Why? Because they're investments. Money market funds is a form of a mutual fund. These are investment funds that seek to preserve the value of your investment at $1 a share. Money held in a money market fund is not insured or guaranteed by the FDIC or any other government institution. It is possible to lose money by investing in a money market fund. Mutual funds are sold by prospectus. Please consider the charges, the risk, the expenses, the investment objectives carefully before investing. And a prospectus contains all this information about investing company, can be obtained from your financial professional, and please read it carefully before you invest or send any money. And lastly here, T-bills. T-bills are actually debt-based instruments. Investors lend to the U.S. government. So again, these are fixed and it's secure. So people like that. So let's consider taxes and inflation. We'll talk about your cash equivalents accounts. We must consider taxes and inflation. So here we have an example. If you looking at these cash alternatives, and we have different choices. So cash alternatives, they offer low risk, right? It's cash. Low also potential returns. But each of these investments are also vulnerable to taxes and inflation. Let's see how it works. So assume we invested $10,000 in a CD that earns 3%. After 1 year, the account will be worth $10,300. But after taxes on the interest is paid, the account would be worth $10,234. And then when you need the account for the effects of inflation, assuming a 6% rate of inflation, the account value would actually be equivalent to $9,620 and your marginal tax rate of 22%. So if you aren't careful, you can actually lose purchasing power. We put that in the chat earlier. With low risk, low potential return investments. Again, this is a hypothetical example used to illustrate for purposes only. It does not represent any specific investment or combination of investment. But if you would, type in the chat for me, purchasing power. Purchasing power, we must consider that when we think about our cash equivalent accounts. Predictable patterns. All right, let's look at that. See if we can see this. Many investors move in and out of cash equivalents depending on the volatility of the market. Okay. In this chart we show here the patterns that unfold in the wake of a recession that began in 2008. The yellow line, as you see, is the S&P 500 index, generally regards as the representative of the U.S. stock market. Beginning in the mid-2008, the market experienced a steep drop and a steady advance. The green line shows the total funds invested in the money market funds account, one of the cash equivalents we're talking about. As you can see, it rises in near mirror image of the stock market line. This means as the market crash, investors move what? Their capital out of stock and into money market funds. A similar trend happened during 2020 pandemic. In both cases, when the market began to recover, they slowly began moving it back. Okay, so though this response to financial instability is understandable, it can be driven by emotion. Type in the chat for me, emotion, and may not benefit the investor. Another approach to consider is to have adequate savings on hand at all times. Money held in a money market fund is not insured or guaranteed by the FDIC or any other government agency. Money market funds seek to preserve the value of the investment at $1 a share. However, it is possible to lose money investing in a money market fund. And again, the Standard & Poor's 500 Composite Index, the total return, is an unmanaged index that is generally considered representative of the U.S. stock market. Index performance is not indicative of past performance or particular investment. Past performance does not guarantee future results. Now here's the famous question: how much do I need to have in cash? At any stage in life, it is wise to reserve enough cash on hand to cover expenses in 3 areas, as you see here. What's the first? The first, you should be able to replace your income for a short period of time in the event of a job loss or the loss of investment income. A good rule of thumb is to have enough on hand to replace your income for 3 to 6 months. Or consider setting aside a fixed dollar amount based on your individual situation. The second, you should make an allowance for emergencies that may occur, such as a catastrophic illness or accident. And third, you should have some cash on hand for upcoming large expenses, such as a wedding or extended vacation. Remember, the FDIC insures bank accounts up to $250,000, 250,000 per depositor and per institution in principal and in interest. However, other cash alternatives such as money market funds are not insured and guaranteed by the FDIC or any other government institution. How much do you need? It would be nice if we can fill out a simple form and determine how much in savings is right for everyone. But each situation is unique, and you may have special considerations that will affect your savings portfolio. After you've made your list of your ongoing expenditures, then narrow the list down to those that are absolutely necessary. You will have a starting figure for your savings. Then ask yourself the following questions. Number one, how many sources of income does your family have? If you have a two-income family, the chances that both of you will lose your source of income are smaller than if there's a one-income household. Next, are you paying off some debt? If so, you may want to keep a lower amount in emergency funds and work to pay down that debt. If you would, put in the chat for me, pay down debt. Next, do you have special circumstances that require extra cash in emergencies? For example, a dependent parent or a child with health concerns may require additional emergency reserves. And lastly, liquidity. Liquidity. If you would type in the chat for me, liquidity. Liquidity of your investments can affect your saving portfolio. If you have investments that are easily accessible, you may need less in your savings portfolio. If, on the other hand, most or all your investments have little or no liquidity, your saving portfolio should be adequate to meet your needs, such as buying bonds or CDs that are time-sensitive and fixed. You cannot touch your money without penalties. So if that be the case, you want to increase your emergency funds just in case for a longer period of time. Finally, examine your own comfort level. For some people, they may require a larger dollar amount than others. So very important to consider those factors, how much you will need. Now let's look at the yield. Yield is return on your money. The yield on a 5-year treasury. Some investors who bought a treasury note in 2020, the pandemic, may have lost some purchasing power as inflation started to pick up. As we know, what happened during 2020 is the government went to save American savings accounts and reduced interest rates to zero. And so as you purchase these 5-year treasury bonds at a very, very low interest rate, and now interest rates are rising, it causes investors to re-examine the role of cash alternatives play in their portfolio. Savings versus investment. This is very important. And it's important not to confuse the two. There's a difference between saving and investing, and many people do confuse it without realizing it. Savings should be in cash, our cash equivalents, which include safe. You type in the chat, safe. Type in the chat, liquid. Type in the chat, easily accessible for emergencies. That's your savings account. An investor's portfolio should be balanced, though, in order to receive the best possible returns with the lowest possible risk. Okay, let me say that again. Best possible returns with the lowest possible risk. So we have to balance return versus risk. The FDIC insures bank accounts, again, up to 250,000. Mutual funds are not insured. So we must strike that balance. The best possible return versus the lowest possible risk. All right. So what's the right formula for you? So look at this illustration here. An investor who may have too large of a portion, as you can see here on the left, of his or her assets in cash equivalents. The money is in a low risk, yes, low return investment. However, the money is not safe from what? Taxes or inflation. Don't forget that. Type in the chat, taxes, type in the chat, inflation. So balancing cash, consider it is not safe from taxes or inflation. These factors cause some investors to reconsider the mix of your investments. That is, some investors may want to pursue investments that are higher risk with the potential for higher returns. One of these options may include a fixed interest investment. A fixed interest investment may have penalties for early withdrawals and other restrictions. So it's important to have adequate savings on a foundational level. Now, this is hypothetical example used for illustrative purposes only. It is not representative of any specific investment or combination of investments. So consider all of that to your unique situation when determining how much cash you should have. Let's look at the speculative approach here with Ron and Susan. Without a definite plan, it's easy to let emotion cause us to jump out to high risk and higher potential returns. Here's an example. Ron and Susan, they have 150,000 in CDs. As they reach maturity, they decide to take 100,000 and divide it between 3 stocks, looking for higher potential returns, but perhaps not understanding that higher risks involved with the stock-related investment. Ron and Susan need to understand that past performance does not guarantee future results. Cash alternatives, fixed interest bonds, and stocks can be important parts of a balanced portfolio. But before you jump, consider your individual situation and understand the risk. Again, this is a hypothetical example used to illustrate purposes. It is not a representative of any specific investment or combination thereof. A measured approach. An example here of Bob and Lydia. It's again the same 150,000 in savings is invested in a CD. When the CD matures, they sit down with their investment professional to calculate their saving needs. They find that their saving portfolio of 75,000 is adequate to meet their income needs in cases of emergency. After some consultation, they decided to place the remaining 75,000 in a fixed interest investment. Again, this is for hypothetical example, illustrative purposes only. It does not present any specific investment or combination thereof. And so with that, taking control of your money is a lifelong process. Here are some questions that arise at different stages in life. Anthony and Selena, it's a 2-income couple with a school-aged children. They ask, how much money do I need in savings to safeguard our current lifestyle? Dave and Christine is a couple nearing retirement, want to know, is there a better place than a savings account to keep our reserves? What should we do with our CD matures? Rebecca is a single parent and a small business owner. She asked, how much investment liquidity do I need in order to protect my interests? And Isaac likes to do research online. He asked, in an environment of low interest rates, should I be taking more risk? The answer to these questions and other concerns will vary, again, for each situation and can be addressed in a review. So please, with these questions, I invite you to a consultation and we can review and address these questions that you may have. I want to thank you for your time today. There are a number of strategies that you can use to find your appropriate mix of cash alternatives. And that's where we come in. We specialize in helping people just like you set up strategies to help them pursue their financial objectives. If you're ready to take the fresh look at your portfolio and take advantage of our complimentary consultation, pick up the phone, schedule a meeting today. My pleasure to present this to you today, and I will then review your questions and questions at this time that you have in the chat. Again, we will be coming back every third Tuesday of the month with another informative presentation of the Money Manners series. I give you back the rest of your time today. Again, appreciate you. Do spread the word. If you found this helpful and informative, let others know about 1847 Financial, HDK. I am Benyamin Levy. Pleasure to see you and help you today. Take care.